Pause for a second. Because what you're about to hear wasn't supposed to happen. Just hours ago, the headlines told you it was over. Gold was finished, silver was broken, fear was everywhere, and yet, while most people were panic selling at the bottom, $4 trillion quietly came back in just 30 hours. Ask yourself this: who moves $4 trillion that fast? Was it you? Was it me? Or was something much bigger happening behind the scenes? Because this kind of reversal doesn't come from hope. It comes from forced selling on the way down and power buying on the way up. Vaults are draining, physical metal is disappearing, and while screens flash chaos, someone is positioning for what comes next. The real question is not what just happened. The real question is, why did it happen right now? And what happens next? Welcome back to Market Metal. If you're someone who's lived through cycles, who's seen markets rise, fall, and rise again, then do yourself a small favor today. Subscribe to this channel, not for hype, but for calm, logic, and clarity when things get noisy. And before we go any further, tell me something in the comments. Where are you watching from today? The event that should not have happened. The rebound began quietly, without ceremony or reassurance. In a market still shaking from days of sharp declines, gold and silver reversed with a speed that defied normal explanation. In just 30 hours, gold rose more than 11% from its lowest point, pushing back above levels many believed would not be seen again so soon. Silver followed with even greater force, climbing nearly 20% from its bottom. Together, the move restored close to $4 trillion in market value, an amount so large and so fast that it demanded attention not as a rally, but as an anomaly. This was not a recovery driven by optimism. It did not come after calming statements from central banks or coordinated policy action. There was no clear headline to explain it, no public announcement of stimulus, no emergency rate cut, no official intervention. The rebound appeared while fear was still fresh, while many investors were still reacting to losses, not planning new positions. That alone made the event unusual. To understand why this mattered, one must first understand scale. $4 trillion is not retail money. It is not the result of scattered buying by individuals or small funds reacting emotionally to price drops. Retail capital does not move with that kind of speed or coordination, especially during periods of stress. The size of the rebound immediately ruled out one explanation. This was not a crowd suddenly changing its mind. The timing raised even more questions. The rebound came directly after a violent sell-off that had erased roughly $11 trillion from precious metals in a very short period. Prices did not drift lower, they collapsed. Margin calls spread across portfolios. Leveraged positions were closed not by choice, but by force. Assets were sold because they had to be sold, not because investors believed they were no longer valuable. This distinction mattered. Forced selling behaves differently from rational selling. It does not wait for better prices. It does not consider long-term value. It sells what it can when it must. When that kind of selling dominates a market, prices can fall far below what fundamentals justify. That is exactly the environment in which the rebound began. What followed was not relief. It was speed. Prices did not slowly climb back. They surged. That surge revealed something important. Buyers were already waiting. They did not hesitate. They did not test the waters. They moved with confidence, size, and urgency. This raised the core question that would frame the entire analysis. Who was prepared to act at that exact moment with that level of capital, while most participants were still in shock? The answer was not found in sentiment surveys or social media discussions. It was found in the structure of markets themselves. In times of stress, markets stopped being democratic. Access matters, balance sheets matter, speed matters. Those with leverage are forced out first. Those with liquidity step in next. The rebound was not a vote of confidence from the public. It was a signal from dominant capital. Gold returning above 4,180 and then pressing higher was not just a price event. It was a statement that the sell-off had reached exhaustion. Silver climbing back above 88 after such a deep fall reinforced the same message. The market was not stabilizing, it was reassigning ownership. To many observers, volatility looked like chaos. To others, it looked like opportunity. But to the few who understand how large capital behaves, volatility was not the problem. It was the mechanism. History offers useful context. Large reversals often follow forced liquidation. They tend to happen when selling pressure has nothing left to sell. At that point, even small buying can move prices sharply. But this was not small buying. The magnitude of the rebound suggested that significant capital had been waiting for precisely this kind of dislocation. That capital did not arrive to rescue prices. It arrived to acquire assets. Another important clue appeared beneath the surface: the physical market. While paper prices had collapsed, physical metal did not behave the same way. Premiums remained elevated, delivery delays persisted, vault inventories continued to decline. These were not signs of a market drowning in supply. They were signs of tightness. This disconnect mattered. Paper markets reflect leverage and speculation. Physical markets reflect scarcity and demand. When the two diverge sharply, it often signals stress within the system. In this case, paper prices fell hard while physical demand remained resilient. That divergence set the stage for the rebound. The $4 trillion recovery did not erase risk, it revealed it. From the perspective of a business leader or a long-term investor, the lesson was not that metals were safe again. The lesson was that the system had just shown how quickly value could be destroyed and restored without warning. That kind of movement does not happen in stable environments. It happens when underlying pressures are building. The rebound also exposed a common misunderstanding. Many believe markets move to reward participation. In reality, markets move to resolve imbalances. When leverage builds, it must be flushed. When fear peaks, control shifts. The rebound was not generosity, it was rebalancing. Those who sold at the bottom did so because they were forced, frightened, or overexposed. Those who bought did so because they were prepared, liquid, and strategic. The speed of the move left little room in between. This dynamic has repeated throughout financial history. In crises, capital does not disappear. It changes hands. Losses for some become entry points for others. The $4 trillion rebound was not a miracle. It was a transfer. What made this event especially significant was its timing within a broader economic backdrop. Global debt levels were elevated. Bond markets were under strain. Currency volatility was increasing. Confidence in long-term stability was weakening. In such an environment, assets tied to monetary trust, like gold and silver, take on renewed importance. Yet even with that context, the rebound was too fast to be explained by narrative alone. Narratives move slowly, capital moves quickly. The event forced serious observers to reconsider assumptions. If prices could collapse and rebound with such violence, what did that say about liquidity? About leverage? About the true depth of the market? More importantly, what did it say about who was really in control? The first part of the story, then, was not about metals, it was about structure. It was about how markets behave under pressure and who benefits when pressure peaks. The rebound was not the end of the story, it was the opening signal. Because when $4 trillion moves in 30 hours, the question is never whether something happened. The question is why it happened then, and who made it happen. That question would guide the next stage of the analysis. The machinery beneath the collapse. The market did not fall because investors changed their minds. It fell because the system demanded it. In the hours before prices collapsed, pressure had already built beneath the surface. Leverage was high. Correlations across assets were tight. Liquidity was thin in places where it mattered most. When one part of the system slipped, the rest followed, not by choice, but by design. Forced liquidation is not a theory. It is a mechanical process. When prices fall past certain levels, margin requirements rise. When margin requirements rise, positions must be reduced. When positions are reduced, assets are sold, regardless of value, timing, or belief. This process feeds on itself. Selling creates lower prices. Lower prices create more selling. The system accelerates downward until it hits a point where sellers run out. That is what happened. The early selling was orderly. Then it was not. Screens flashed red across markets. Stop-loss orders were triggered. Risk models adjusted in real time. Funds that had nothing to do with precious metals were forced to sell metals anyway to meet obligations elsewhere. Gold and silver became sources of liquidity, not expressions of conviction. At that stage, no one was asking whether gold or silver were worth it. The only question was what could be sold quickly. This is the moment most observers misunderstand. They see falling prices and assume belief is collapsing. In reality, belief becomes irrelevant. The system is no longer deciding, it is executing. As prices fell, volatility rose. Higher volatility triggered higher margin requirements. Higher margins forced more selling. It was not emotional, it was automatic. The market was not panicking, it was obeying rules. This is why the rebound mattered so much. It revealed the exact point where forced selling ended. Once that selling pressure exhausted itself, something changed. The selling did not slow, it stopped. And in markets, when sellers vanish, even modest buying can move prices sharply. But this was not modest buying. The rebound came with speed, size, and coordination. That combination does not belong to retail traders or short-term speculators. It belongs to institutions that understand how these cycles work and prepare for them in advance. These buyers were not reacting, they were waiting. Their strategies are built for moments like this. They do not chase rallies. They do not argue with trends. They wait for stress. They wait for dislocation. They wait until sellers are no longer choosing to sell, but are forced to. At that point, price becomes negotiable. Algorithms took over first. They recognized liquidity gaps. They identified price levels where forced selling had likely ended. Orders were placed not in emotion, but in sequence. As prices moved higher, more buyers joined, not out of fear, but out of confirmation. The result was a squeeze in reverse. Those who had sold short into the collapse were suddenly exposed. As prices rose, they were forced to cover. Covering became buying. Buying pushed prices higher. Higher prices forced more covering. The same mechanics that drove prices down now drove them up. This symmetry is often missed. Markets do not care about direction. They care about imbalance. During the collapse, selling overwhelmed demand. During the rebound, demand overwhelmed selling. Both phases were violent because both were mechanical. The paper market told this story clearly. Trading volumes spiked to levels rarely seen. Liquidity surged where it had been absent just hours earlier. This was not the behavior of a calm market finding balance. It was the behavior of a stressed system releasing pressure. This meant something critical. The selling pressure was concentrated in derivatives, not in real metal. Paper contracts can be created and destroyed quickly. Physical metal cannot. When paper prices fall sharply without a corresponding surge in physical supply, it often signals that price discovery has become distorted. That distortion does not resolve slowly, it resolves suddenly. The $4 trillion rebound was that resolution. For decision makers, the lesson was uncomfortable. The system had just demonstrated that prices could be driven far below equilibrium by structural forces, and then snap back violently when those forces reversed. This is not a sign of health. It is a sign of fragility. The more leverage a system carries, the more violent its corrections become. The more interconnected assets are, the faster stress spreads. In such an environment, volatility is not noise. It is information. The rebound also revealed who was not in control. Retail participants did not decide when selling stopped. Short-term traders did not decide when buying began. Control passed from those reacting to those prepared. This is where power consolidates in markets. The individuals who sold at the bottom did so because they had no alternative. The entities that bought did so because they had planned for that exact moment. They understood that when forced liquidation ends, value reasserts itself, not gradually, but abruptly. This is why the phrase, buy the dip, is misleading. Dips are emotional. Forced liquidations are structural. The rebound was not opportunism, it was execution. As prices moved higher, confidence did not return evenly. Many who sold were unable to re-enter. The speed of the rebound locked them out. This is another feature of such events. They punish hesitation on both sides, fear on the way down and disbelief on the way up. For long-term observers, the more important signal was not price, it was behavior. The system had shown that it could no longer absorb stress smoothly. Instead, it released it in bursts. That pattern has consequences beyond metals. It affects equities, bonds, currencies, and credit. When markets behave this way, stability becomes conditional. It depends on constant liquidity, constant confidence, and constant control. Remove any one of those, and pressure builds again. The rebound did not remove that pressure. It confirmed it. This was why serious capital moved quickly. They were not celebrating a bottom. They were repositioning ahead of the next phase. Because when markets rebound this fast, after forced liquidation, it rarely marks an ending. It marks a transition. And transitions are where power shifts quietly, before the rest of the world realizes the rules have changed. The buyers. No one sees. The rebound raised one question that refused to go away. If this was not retail money, then whose money was it? The answer did not appear on trading screens. It did not show up in headlines or press releases. It did not announce itself. Instead, it revealed itself through patterns. Slow, deliberate, and consistent patterns that only become visible when emotion is stripped away. These buyers do not chase price. They do not explain themselves. They operate on timelines that stretch far beyond a single quarter or a single election cycle. And when they move, they do not do so for profit alone. They move for positioning. This is where the story shifts from markets to strategy. For sovereign actors and long-horizon institutions, gold and silver are not trades. They are infrastructure. They sit at the foundation of credibility, balance sheet strength, and monetary resilience. They are not measured in days or weeks, but in decades. That difference in mindset explains everything that happened next. While the paper market convulsed, physical flows told a quieter story. Vault inventories continued to fall. Deliveries continued to move east. Premiums remained above historical norms even after the crash. None of this aligned with the idea of panic selling of real metal. It aligned with accumulation. This distinction mattered more than price. Paper markets reflect leverage and speed. Physical markets reflect intent. When paper prices collapse but physical demand remains firm, it suggests that the selling pressure is temporary and artificial. It also suggests that someone is willing to absorb supply without drawing attention. These buyers do not announce when they are done. They simply stop buying, and the market feels it later. Gold plays a special role in this process. Unlike most assets, gold has no counterparty risk. It does not depend on a promise to pay. It does not default. It does not dilute. For governments managing large debts and fragile currencies, this matters. Silver, while more volatile, plays a parallel role. It is both monetary and industrial. It sits at the intersection of finance and production. Control over silver supply is not just about wealth, it is about capability. This is why accumulation patterns in precious metals often intensify during periods of stress. Not because metals are fashionable, but because they function when other systems strain. The $4 trillion rebound did not create this demand. It exposed it. Evidence of this behavior appears indirectly. Official reports often show modest increases in reserves. Trade data shows much larger flows. Import numbers do not align neatly with reported purchases. This gap is not accidental. It is strategic. Sovereign buyers do not benefit from transparency while accumulating. They benefit from patience. When prices collapse due to forced selling, these buyers see opportunity, not danger. They understand that the selling is not a rejection of value. It is a malfunction of structure, and malfunctions are temporary. This helps explain the speed of the rebound. These buyers were not surprised. They were prepared. The moment forced selling ended, accumulation resumed, and prices responded. This behavior also explains why the rebound felt disconnected from sentiment. Confidence had not returned. Fear was still present. Yet prices moved higher anyway. That disconnect is a hallmark of sovereign and institutional buying. They do not wait for consensus. They move against it. Another signal appeared in geography. Pricing power continued to shift eastward. Western paper prices diverged from Asian physical prices. Even after the rebound, gaps remained. That gap represented more than arbitrage. It represented demand that was not sensitive to short-term volatility. Where price is lowest, accumulation concentrates. Where price is highest, supply appears. Over time, this shifts the center of gravity. This is not new. It has happened before in history during periods of monetary transition. Control over monetary metals gradually migrates away from financial centers toward accumulation centers. Price discovery follows later. What makes this moment different is speed. Global systems are more connected than ever. Leverage is higher. Debt levels are larger. Trust is thinner. When pressure builds, it releases faster. When rebalancing occurs, it does so with greater force. The rebound was one such release. For decision makers, the key insight was not optimism. It was alignment. The interests of large accumulators were becoming clearer. They were not betting on calm markets. They were preparing for disorder. This preparation does not require public coordination. It requires shared incentives. Nations with large debts, trade imbalances, or currency exposure all face similar risks. Precious metals offer similar protections. When many actors reach the same conclusion independently, accumulation accelerates quietly until it becomes impossible to hide. The $4 trillion rebound suggested that the hiding phase might be ending. But this does not mean the transition will be smooth. Accumulation during stress increases volatility. It does not reduce it. As paper markets struggle to reflect physical reality, price swings widen. This creates a difficult environment for those who rely on short-term signals. False bottoms appear, sharp rallies reverse, confidence erodes further. Yet beneath this turbulence, something steadier is happening. Ownership is shifting. Metal is moving into hands that are unlikely to sell it back easily. This matters because future supply is constrained. Mining output does not respond quickly to price. New production takes years to develop. When accumulation accelerates during stress, replenishment lags behind. The rebound did not solve this imbalance. It highlighted it. From a strategic perspective, this creates tension. On one side are paper markets that require liquidity, stability, and confidence to function smoothly. On the other side are physical markets where supply tightens and demand persists regardless of price swings. That tension cannot last indefinitely. Eventually, one side must adjust. Either paper prices must reflect physical scarcity or physical demand must collapse. The rebound suggested which outcome was more likely, but the most important signal was not what had happened. It was what had not happened. Despite the largest paper sell-off in recent memory, there was no flood of physical metal back into the system. There was no sign that long-term holders were exiting. There was no evidence that accumulation had stopped. This absence spoke louder than any price chart. It suggested that the rebound was not an end, but a checkpoint. The buyers no one sees had shown their hand, not through announcements, but through action. They had absorbed forced selling. They had taken advantage of dislocation, and they had done so quietly. The market had responded accordingly. What remained unresolved was how the broader system would react next. Would stress in other areas force another wave of liquidation, or had the floor shifted upward due to this accumulation? That question would define the next phase, because when invisible buyers step in during chaos, it is rarely to stabilize markets for everyone else. It is to prepare for what comes after. The warning hidden inside the rebound. By the time prices stabilized, many believed the danger had passed. Gold was back near prior levels. Silver had reclaimed lost ground. Headlines softened. Commentators spoke of relief. But the rebound was not a resolution. It was a message, and it was easy to misread. For those watching carefully, the rebound did not signal safety. It signaled exposure. Markets do not move like this in healthy systems. They move like this when pressure has been building unseen, when leverage has outgrown resilience, and when confidence depends on constant liquidity. The speed of the recovery was not comforting. It was alarming. $4 trillion returning in 30 hours meant that capital was still present, but it was selective. It moved where it felt protected and exited where it felt vulnerable. That distinction mattered more than price direction. The system had just demonstrated something uncomfortable. Prices were no longer anchored to stability. They were anchored to stress. This was the warning. When forced liquidation drives prices far below equilibrium and accumulation drives them sharply higher, the result is not balance. It is oscillation. Volatility becomes the norm, not the exception. In such environments, timing becomes dangerous and structure becomes everything. The rebound also exposed the fragility of trust. Confidence did not return evenly. Many participants remained sidelined, unsure whether the rally was real or temporary. That hesitation is itself a signal. It suggests that belief in smooth market function has weakened. This matters because modern markets rely on belief as much as capital. They rely on the assumption that liquidity will always be there, that exits will always be available, and that price signals will reflect reality. When those assumptions crack, behavior changes. The events surrounding the rebound hinted that those assumptions were already under strain. Bond markets were flashing stress. Yield volatility was increasing. Currency markets were shifting faster than expected. These pressures were not isolated. They were connected. Stress in one area forced liquidation in another. Metals were hit, not because they failed, but because they were liquid. This is a critical point for decision makers. Assets are not always sold because they are weak. They are often sold because they are strong enough to sell. Once that forced selling ended, capital flowed back into metals quickly. Not because risk disappeared, but because risk elsewhere remained unresolved. This reframes the rebound entirely. It was not a vote of confidence in calm markets. It was a repositioning away from fragility. The deeper warning lay in what this meant going forward. If stress continues in debt markets, if yields remain unstable, if currencies face renewed pressure, then the conditions that caused the initial liquidation can return. Another wave of selling is possible. Another flush cannot be ruled out. At the same time, the accumulation seen during the rebound suggests that each forced sell-off may encounter stronger buying sooner than before. Floors may rise even as ceilings remain unstable. This creates a market defined by sharp drops and faster recoveries. For businesses, investors, and institutions, this is not an environment to navigate casually. Short-term price movements become less meaningful. Long-term positioning becomes more important. Exposure must be understood not just by asset class, but by structures, leverage, liquidity, and counterparty risk. The rebound also underscored a shift in what markets reward. They no longer reward participation. They reward preparation. Those who survived the sell-off intact were not those with the strongest opinions. They were those with the strongest balance sheets. They had margin. They had liquidity. They had patience. Those who were forced out were not necessarily wrong. They were overextended. This is the uncomfortable reality of modern markets. Correct ideas can fail if structure is weak. Incorrect ideas can survive if structure is strong. The $4 trillion rebound exposed this truth without apology. Another layer of suspense lies in timing. Key delivery periods approach. Physical inventories remain tight. Accumulation continues quietly. At the same time, macro pressures have not eased. Debt levels have not fallen. Fiscal constraints remain. Policy flexibility is limited. These forces are moving in opposite directions. On one side is a system that requires calm to function. On the other is a reality that keeps generating stress. The rebound did not reconcile these forces. It brought them into sharper conflict. For now, price action masks this tension, but markets rarely hide tension for long. The final warning, then, is not about metals alone. It is about how markets behave when confidence erodes gradually rather than collapsing suddenly. In such periods, volatility becomes episodic. Shocks arrive without warning. Recovery is swift but uneven. Those who mistake rebounds for resolutions are often caught off guard by what follows. The $4 trillion rebound was impressive. It was historic, but it was not reassuring. It revealed that the system still depends on forced selling to reset itself. It revealed that large capital is willing to step in, but only on its own terms. It revealed that price stability is conditional, not guaranteed. For decision makers, the implication is clear. Risk has not vanished, it has changed shape. The choice is not between optimism and pessimism, it is between reaction and preparation, between relying on narratives and understanding mechanics, between assuming liquidity and managing without it. The rebound closed one chapter, but it opened another, because when markets recover this violently after being pushed down by force, they are not signaling the end of danger. They are signaling that the system is still under pressure, and that the next test may already be forming. The warning was never in the collapse. It was in the speed of the recovery.